What we are seeing in the US housing market is active inventory is increasing nationally, and it's increasing in almost every market. As homes take a little longer to sell, there's less demand, the seller isn't getting the price they want, that active inventory begins to build.
Which I think is a strong indication of what may be coming. Inventory spiking, prices coming down. We're not really in the time of year where we would traditionally see houses going on the market. So it is screaming a bigger warning signal to me that affordability is playing into the issue, pushing people to sell.
We are passing through a full-blown property taxes, home insurance shock in the US housing market right now.
We've got this ridiculously overpriced market, and what's happening with the taxes and insurance is like tipping the scale on a massive level. Take us through your list. We're going to talk about the top 8 where you're seeing the inventory explode. What's number 8? Lance Lambert, welcome back to the show.
Housing. Thank you for having me again.
Absolutely. For those that don't know who you are, I find that hard to believe nowadays, but tell everybody a little bit about what you do.
So I'm a longtime financial and data journalist. I've worked at places like Bloomberg, Realtor.com. I was at Fortune magazine for 4 years as their real estate editor. And I think my niche is just, really digging into the data, making lots of charts, maps, looking at what's going on in the US housing market. And then I have a great network of sources right across the country. I have a lot of the CEOs at a lot of these companies, a lot of the institutional side, the home builders. I just track the whole market and trying to figure out what's going on at any given time. And I'm a straight shooter. If there's parts of the market that are down or things are choppy or aren't looking good, I'll say it. If it's the other way and things are kind of heating up or starting to take off, I'll say that as well. And so I have a company called Resi Club. We're a data-driven research and news outlet. You can find us at resiclubanalytics.com. And all of our coverage of the U.S. housing market is very data-driven and independent.
That's awesome. Well, I like what you do, and it's nice to see some actual truths in the market where, you're not just pushing narratives for the stock market or Wall Street or any particular company. So excited to see what you're noticing in the housing market right now. And we'll just kind of start out with that. I mean, Lance, what are you seeing really nationwide overall from a macro scale with the housing market that may be either concerning to you or something that's just standing out?
Yeah, I think the biggest concern with the U.S. housing market right now is what I call the echo pandemic housing boom. So you had an overheating for prices that occurred in late 2020 into 21, into 2022. And then once rates spiked, that really changed, right? Some markets continued to go up a bit. Others started to fall. Some were kind of flat. But what we have seen since then is prices on a nationally aggregated level haven't necessarily went too much of anywhere, right? But what we are starting to see is still affordability hits. And this time it's not just being felt by buyers because buyers feel it when prices overheat and when rates overheat. But now it's the carrying cost, right? Home insurance, property taxes, all of the things that have a lagged increase from prices, those are the things that are cooking up now. And so we are passing through a full-blown home insurance shock in the U.S. housing market right now. And that shock is being felt through higher premiums. It's being felt by premiums not being able to rise enough. And so there's, policies that aren't being renewed. And I'll be able to pull up all this data and show it across the country. But that home insurance shock is very real. And it's hitting some places harder than others. And before we jump into some of the data, would you be okay if I just showed some of the data for home insurance?
Absolutely.
So this is the 3-year change in median annual home insurance. This is something that I produce for my clients over at Resi Club. You can see that Florida, Louisiana have gotten the biggest hits, being up in a lot of places of Florida, 50, 60, 70, 100% in a 3-year period. And the rest of the country, still lots of 20s and 30%. It just doesn't stick out as much when you have Places like Florida, Louisiana, pockets of the Mountain West up so much. And what we're also starting to see is more home insurance non-renewals. Just got this new data from we got it emailed to us from the U.S. Senate Budget Committee, and it's by county. And what we have seen is almost a doubling in the rate of home insurance non-renewal rates on a nationally aggregated level. On a national level, it's still only around 1.5%, but there are places in Florida where it's 16%, 9% of all policies in a year period were not renewed. And so what's going on there is, they're trying to pass on the premiums, and maybe they believe those markets are higher risk and they're not fully able to pass it on. And so they non-renew. And some of it is also slowed down by politically appointed state insurance committees and commissioners who don't want to feel the political blowback of premiums rising too fast, too quickly. So they don't approve it, they don't allow it. And then places like State Farm in California are like, you know what? If we can't do it, we're out. And what's driving home insurance up is the echo pandemic housing boom, one, which is, construction and home prices overheated. And for, the insurers, that means the replacement cost have went up a lot, right? If that home's destroyed, if it's damaged, to repair it, to renovate it, to replace it is much higher. And so that feeds over to it. The other part is we have seen a lot of building in the US that is being built into the very markets with the highest disaster risk, right? A lot of the Gulf region. And so as the US housing market gets more and more concentrated into higher risk areas, that puts upward pressure on premiums. And then a third component here is the risk models for disasters in the future. They are increasing what they think the payouts will be. So the people building these risk models believe that there will be more disaster climate risk in the future, and so that's feeding into it. John Rogers is the chief data and analytics officer over at CoreLogic. He has a team of 200 data scientists. He has meteorologists, a whole team of people for climate and data. And insurance companies buy their data to help to build their risk models. And the story that I put forward, the higher cost replacement, higher concentration in these high risk areas, and then the high risk, those are all the factors that he and his model are seeing in the data that they're providing to the insurance companies. And so the biggest shock here for the non-renewals, some parts of California, some parts of Oklahoma, but really, around New Orleans, southern Florida, and then this coastal area, the Carolinas, is getting hit particularly hard. And going back to Florida and back to this discussion of affordability, Florida is really interesting because not only did it see the biggest increase in home prices during the pandemic housing boom, or right there, it it's also seen the biggest shock for home insurance, the biggest jump for home insurance. So you take a place like Lee County, Florida, home insurance is up 72%, and then home prices are up 56%. All of that far, far above the national average. And so that just creates a more acute affordability shock into some of these parts of Florida versus, let's say, you know, um, some parts of Michigan or or Arkansas, some of these Midwest markets that haven't seen quite that level of an affordability shock.
Talking about the non-renewal of insurance, do we know in the data if or what the percentages are of people that don't have mortgages? Because if you have a mortgage, you're in default of your mortgage if you don't have a insurance policy, homeowner's policy, because the lender obviously wants to protect their asset. They don't want you to not have insurance. Do we know if there's a certain percent or what that would be of people that where their homes are paid off, but they simply can't afford the insurance, so they didn't renew it? Looking at that slide, it really didn't say the difference between insurance companies not renewing or homeowners not renewing.
Yeah, so a few thoughts there. just because your home insurance doesn't renew you and your policy drops, or that insurer pulls out of the state, you still would have time, because a lot of these states have rules in terms of how early they had to notify you to go find another home insurer, and to switch. Because of course, if you do have a mortgage, that is a part of it, right? You have to have home insurance. Now, what's interesting is that in the US, because of a secular shift where the age of Americans on a distribution basis is getting older, right? And the older people are, the more likely they are to have a paid off mortgage, right? If you're 60, 70, there's a possibility, right? You don't have a mortgage anymore. And so the share of the US housing market that does not have a mortgage has increased since 2010 from around 33% to now 40%. And so those 40% of US homeowners who do not have a mortgage, some of those, because these home insurance premiums have gotten so high and because many of them are fixed income, they're not taking on a home insurance. And so when their non-renewals are up, or when they find these premium notice, some of them are not getting home insurance. And we have already seen stories from Hurricane Milton where some of these retirees on fixed income who could no longer afford their home insurance premium, uh, they lost everything, because they didn't have home insurance because they couldn't afford it. And so the shock that that's creating is some of these retirees down in some of these coastal and southern markets are starting to realize, because they're on fixed income and their housing costs are higher than they would have expected, because the increases for property taxes and the increase for home insurance. And so some of them are selling. Some of them are selling to move back up north, you know, or they're selling to move in with family. And so it's not a lot of supply, but it's just enough in this strained housing market environment that it can soften your local market and create a little bit more power for buyers.
Before we dive into what's happening with the inventory, because there are a lot of areas across the country that are spiking, we're going to cover the 8 top areas where the highest inventory year over year has occurred, which I think is a strong indication to me of what may be coming. Because of the time of year that we're in. We're not really in the time of year where we would traditionally see houses going on the market. So it is screaming a bigger warning signal to me, and the brokers that I'm talking with, that affordability is playing into the issue, pushing people to sell. I want to just quickly touch on the fact where you were saying we're talking about affordability. We're now talking about inventory spiking, prices coming down in a lot of markets. I was reminded of the madness that occurred in really from 2020 to 2022, somewhere around June, after the Fed started raising rates and it affected mortgages back in March of 2022. But really, we saw a major slowdown in affordability, the ability for people to afford a mortgage around June of 2022. That's when we really started noticing it on the sales side. But it reminded me, one of the commenters on my YouTube channel reminded me of how crazy it was in that time where people were overpaying for homes. When you get a loan or a mortgage on a house, one of the things that the lender or the bank is going to do to protect themselves in lending you the money is they're going to get an appraisal. And for the first time at scale, we experienced where people were paying over appraised value for houses. And it was happening at such a rapid pace that the housing market just blew up. So when people are saying that this market won't correct, we have to really look at what happened. Never in history, or at least in my career, did I see a time, even in 2000 leading up to the peak in 2006, before the GFC, the great financial crisis, where the housing market crashed, the largest since World War II, we didn't see the people paying over appraised value. We saw them bidding things up, but they still had that sort of like safety net of, well, we'll bid this, but if it doesn't appraise, the seller's going to have to adjust the price. And there was some cooking in the books back then, I feel, where the appraisers would give them whatever they wanted. But the difference this go round was that people were bringing cash to the table like we've never seen before. They were overpaying the appraised value, $50,000, $100,000, $300,000 in some cases, depending on the list price of the house, just to win the house. So now we've got this ridiculously overpriced market. And as you're saying, the what's happening with the taxes and insurance is like tipping the scale on a massive level. So I don't know if you have anything you want to add to that before we move on.
I think the big thing is just a series of affordability shocks that we've gone through. Where the first one was price, that was just felt by buyers, right? If you're a homeowner, there's not necessarily a big negative to that, right? You're actually gaining equity. Your mortgage payment isn't going up, right? Interest rates going up, that again is a hit to buyers, but for the homeowner, they're not really feeling it. And a lot of them actually lowered their payment during the pandemic housing boom because they were able to go down to like two something rates, or some of them even got 15-year at like 2.2. Or if you went to like Silicon Valley Bank, which was doing some suspect mortgages, you could actually have gotten like a fixed 30 at like 2.2. And but after that, now that we're in the home insurance shock, that's being felt by the buyer and the homeowner, right? Their mortgage payment actually goes up. And so that increases the carrying cost. Now with the property taxes, because home prices are up 40, 50, 60% in some markets, that again is going to the carrying cost and putting upward pressure on mortgages in some of those states and municipalities that are passing that on. So the picture here is starting to change, and more of the affordability hit is getting spread out to also the homeowners themselves.
Let's talk about this spiking in inventory. Do you know Wolf Richter?
I've seen a little bit of his stuff from time to time.
I just want to pull up before we dive into your data something that was just published, a couple days ago by Wolf Street, which is his report, and he's an analyst as well. And this one has some information here that I knew it was happening, but it's when you start seeing people writing about it and starting to see people like you writing about it. It's titled "Inventory of New Completed Single-Family Houses for Sale Spikes to Highest Since 2007. Builders prop up sales with lower prices, bigger incentives, and smaller houses." But he writes in this article, home builders need to sell this inventory of spec houses. And what happens once they're completed, they're built out, quick move-ins, they call them. These are actually spec houses, but they need to move these quickly because they've sunk a lot of capital into the houses. And because they're continuing to build at a faster clip, then they're selling them because they want to run the growth businesses and please Wall Street, thereby adding to a pile of inventory on a monthly basis. Big publicly traded home builders have to build and sell homes regardless of the market because they have to keep their businesses intact and growing, and they have to please Wall Street to keep their shares from tanking, which we're now seeing from the home builders. So, and I guess the thing here, Lance, is somebody that used to build houses. I've built houses. I've been a contractor for forever. When I'm looking at the market indicators, I'm looking at the new home market because that's really what leads the market crash or correction in 2008. I mean, it affects the builders first because they have to sell. So they're the ones that are suppressing and playing with the concessions and the enticements, incentives for the buyer. And now we're starting to see that in things that are showing up like price being dropped. So one of the things we'll talk about real quick here is this John Burns chart. And I don't know if this correlates with what you're about to tell us, but home builders' incentives on unsold inventory homes as percentage of sales price in fourth quarter of 2024 Florida led the market at 10% off in pricing, but you can see on a national level, 7% is the price reduction on average to unsold home inventory that they've had to, apply to get buyers to bite, and their sales are still way down. So take us through your list. Give us. We're going to talk about the top 8 where you're seeing the inventory explode. What's number 8? I hope you're enjoying the interview so far. I just wanted to take a brief moment and let you know that this podcast is brought to you by SachsRealty.com. Here at Sachs Realty, we're committed to bringing you the best real estate education and helping buyers and sellers achieve their real estate goals. If you haven't subscribed to our channel, please consider doing so now. And don't forget, we're on every major social media platform, so you can follow us there as well. Now back to the show.
Yeah. So what we are seeing in the U.S. housing market is active inventory is increasing nationally, and it's increasing in almost every market. There's only around, just a couple of outliers for active listings. And what an active listing is, it's everything for sale at any given time, right? It's not necessarily what's coming up for sale, but it's everything for sale. And so as homes take a little longer to sell, there's less demand. The seller isn't getting the price they want. Those active inventory, that active inventory begins to build, right? So it can build even if the number of new listings, what people are actually listing for sale isn't going up that much. Right now, we're not seeing a lot of new listings. That's still very tight because there is this lock-in effect that's really constrained churn in the market. So there's not a ton of homeowners that are like, you know what? I want to sell my home and go buy something else. They're not doing it because their mortgage rate would go up 800 bucks, 900 bucks, 1200 bucks. And even if they wanted to, a lot of them don't make enough household income to afford that new mortgage. They just can't afford to do it. And so the churn in the market has been constrained. Now, active listings are beginning to build, but that build is also concentrated in different markets. And let's go through the markets that have seen the 8 biggest inventory jumps over the past year. So December 2023 to December 2024. And these are measured from the 200 largest markets. So these are the 8 that have seen the biggest jump. At number 8 is Denver, Colorado. They're up 42% year over year for active listing growth. And what's occurred in Denver is that their domestic migration coming in from California, coming in from these other high cost areas like Seattle, has really decelerated and it's come down. And so that's decreased housing demand coming into the market. And at the same time, they have the same affordability hit as everyone else. But in the outskirts of Denver, they also have a good number of single family homes being built. They have a larger presence from the home builders. I can tell you that looking at the data, the greatest weakness in Denver is in the condo market in particular. That's where a good amount of this active inventory growth has occurred. But so Denver is up 42% year over year for active listings, and they are actually 15% above pre pandemic inventory levels. Number 7 is Orlando, Florida. They're up 42% year over year for active listings. Orlando is also seeing a slowdown in net migration coming in. During the pandemic housing boom, there were a lot of people moving into the Orlando metro area, coming from Boston, coming from New York City, New Jersey, Chicago. That's really decelerated. Now, there's still people moving to Orlando, but it's not at all like it was in 2021, early 2022, once rates kind of spiked and, work from home gained just a little bit of momentum. That migration burst really decelerated. And a lot of the moves that were occurring down to Texas and Florida during the pandemic, a good number of those moves were going to occur anyway. They were going to occur in 2023, 24, 25, 26. It just all, so much of it got pulled forward to 21, 22 because there was work from home and such low mortgage rates and all the stimulus money too. And so Orlando is up 42% year over year for actives, and they are up 35% above pre-pandemic inventory levels. So of the 8 that I'm gonna run through here, Orlando's 7th, but it is actually the weakest of all these markets because they've been growing for inventory for a while and are now 35% above pre-pandemic levels. Next at number 6 is Kingsport, Tennessee. They're up 42% for active listings year over year. They're still a little bit tighter. They're still down 29% from pre-pandemic levels, but they got some momentum going for their active inventory growth there. And again, it's another one of those markets where some of the migration has kind of decelerated. Tucson, Arizona is number 5. They're up 43% year over year for active inventory growth. This one is a little bit weaker than some of these other ones. They're a little bit closer to Orlando. They're up 26% above pre pandemic inventory levels. So there's more homes for sale today in Tucson, Arizona than there was back in 2019. And this market is another one where net domestic migration has slowed into the market. There's some building there. They're not seeing as many retirees move into the market as before. And so active listings are building, and buyers have pulled in a good amount of power relative to what they had a couple years ago. At number 4 is Naples. They're up 45% year over year for active listings. Naples is interesting. It's home to one of the wealthiest housing markets in the country. A lot of high end, high income, wealthy retirees moved down to Naples. It took a little longer to slow down than some of these other Florida markets. There was still kind of some of that money moving in, but the Naples market has been hit by a slowdown in net domestic migration. One, two, they've seen a much bigger home insurance shock than a lot of the other markets in the US, like we ran through earlier. The market has also been affected by the Surfside condo collapse that occurred in 2021 in Florida, and it killed, I believe, 98 people. Very quickly, the building collapsed. And coming out of that, the state legislature in Florida passed a good number of measures to kind of keep these older condo buildings from deferring maintenance, getting them up to a higher code. And so, what that's done is it's created a greater shock for HOAs and special assessments. And a good number of these, condo owners are being asked to fork out 100 grand in special assessments because they determined that that older condo building just isn't up to code and they need more money and to stop deferring maintenance. So the older the condo building in these coastal areas of Florida, the weaker they are in the resale market because nobody wants them because the price the carrying cost have went up so much. And so that has really added to the inventory in Florida that's for sale because buyers are much more hesitant to buy these older condo buildings and even some of the newer condo buildings. They're just kind of wary of condo buildings at the moment. But Naples is still relative to some of these other Florida markets. I wouldn't call them tight. They're not a tight market. They are 2% above pre-pandemic levels, but they're not necessarily as weak as, you go just north of Naples to like Punta Gorda or Cape Coral, Sarasota. Some of those markets, buyers have gained much more power. At number 3, Miami. They're up 45% year over year for active inventory growth. They're still 2% below pre-pandemic inventory levels, but they're growing quickly. And again, a lot of it is just like with Naples. There's a home insurance shock there that's very acute. They've seen a deceleration in net domestic migration. A lot of the tech people that were leaving Silicon Valley and heading to Miami, or a lot of the people in finance in New York City moving down to Miami because they thought it was going to be this huge hub of the future. That, there's still some of that happening, but it's pulled back and some of the people have actually left. There's been a pickup in out migration as well. So people are still moving to Florida and places like Miami, but it's not like it was before. And so that has pushed this demand supply equilibrium to a place where the market is much cooler than it was before. And when you add in the home insurance, and then you also add in the shock to the condo market, it's really changed the dynamics in the Miami market. I will say that Miami and Naples, you still see more resiliency in single family than you would condo. It's definitely the weakest on the condo side. And number two, and this is actually the most interesting one on the list, it's Burlington, Vermont. Burlington, Vermont is now up 47% uh, year over year for active listings. Now, the thing to remember is that while a lot of the South and Mountain West has seen inventory growth over the past couple years, the Northeast and Midwest has stayed fairly tight. There has not been a jump in resale, right? In those markets, there's not a lot of home building occurring. And given that there's a lack of home building and you're not necessarily seeing the discounting on the home building side, right? And those affordability adjustments that are drawing some of the attention from the existing market and resale market to the new construction market, like you're seeing in places like Orlando and Tampa and Tucson and Phoenix. You're not seeing as much of that in the Midwest and Northeast because there just isn't the home building levels. But you are starting to see now inventory growth in a couple of these pockets of the Northeast. They're still below pre pandemic levels. So Burlington, Vermont is up 47% year over year, but they're still down 48% from pre pandemic levels. But it's moving up. The trajectory has changed. And so I think noting that the trajectory has changed really makes it a moment where these next 12 months, let's keep an eye on the Midwest. Let's keep an eye on the Northeast. Let's see if that active inventory build continues. And do they finally start to see, buyers gain a little bit of the power from sellers like we've already seen in a lot of these pockets in the Gulf area, in the Mountain West? Because as of right now, despite mortgage rates going up from 3 to 7%, sellers have still retained a good amount of power in the more affordable Northeast and Midwest markets, especially relative to the South. So let's keep an eye there and let's see what happens the next 12 months with Burlington and some of those pockets of the Northeast and Midwest. Uh, Number one, drum roll. Number one is Savannah, Georgia. They're up 60% year over year for active inventory growth. They're still a little tighter. They're not as, buyers haven't gained as much power as like Orlando. Savannah's still down 29% from pre-pandemic levels, but the trajectory is moving up. There's a good amount of inventory build starting to happen in Savannah. The supply demand equilibrium has moved to a place where buyers have gained some power, and so homes are taking longer to sell. Existing sellers that were kind of remembering the 2022 market, and kind of coming in with aspirational pricing, they're not getting what they thought they were. They're not finding the buyers that they remembered hearing about in 21, 22. They're not there like they were before. And so existing home sellers, as they don't get their price they want, they have to stay on the market longer, and that active inventory begins to build. Active inventory is just like a car dealership. If you drive by a car dealership and that place is looking pretty empty, it could be because it's just a very hot market and things are flying off the shelf, right? But if you start to drive by that car dealership and it's slowly getting bigger and bigger, and there's more and more cars, or maybe it's like a used car dealer lot and they're getting to the point where there's like almost overflow, right? That's when the dealership is going to do the best discounting, right? Because they're not being able to sell, they're not being able to move product. And that's when you as a buyer begin to gain more and more power. And so these places where active inventory is built, I will say that they vary a lot in terms of like the buyer seller power. Whereas if you go into Orlando or some of these pockets of Denver, especially in the condo market, you're going to have a lot of power, right? Now, if you go into places like Savannah and you go into places like Kingsport or Burlington, you're not going to have as much power, but you've gained power relative to how much you had a couple years ago. And you're still gaining power. And if we have a second, I would love to show some of the maps just to kind of roll through what I'm seeing in the market. So this is the 1-year change in active inventory for sale. You can see places like Miami, where they've gone from having 17,000 listings in the entire metro area in December 21. Now they have 45,000. And that's soared all the way back from 17,000 listings to 44 in a 3-year period. And that's taken us back above pre-pandemic levels. And then here you have Savannah. Savannah has shot up from 600 listings to 1,600. Um, and so the trajectory there, you can see it's really starting to move up, but it's still below pre-pandemic levels. But the year over year jump has been pretty big. And actually, there's been a pretty big jump year over year in the pockets of northern Georgia, uh, eastern Tennessee, western North Carolina on a year over year basis. I don't know if some of this is driven by Hurricane Helene, which is where you saw a lot of the flooding. I'd had to look at the numbers a little closer, but I actually believe, if my memory serves me right, this was already growing at a accelerated pace even before Hurricane Helene. So you're starting to see buyers gain a good amount of power there.
I think we're probably a little bit early to see sellers as a result of Helene. They're still dealing with trying to, you know, gain housing, right, from FEMA or whatever, getting some kind of a relief. So it probably is a result of just inventory mounting, regardless of Helene.
Yeah, I think that's right. And I think Helene, if you use I think it was Hurricane Ian that hit in September 2022 into like Punta Gorda, into Cape Coral, Sarasota. If you use that as a proxy, you would estimate that Helene would start to impact more of like the North Carolina housing market and that Eastern Tennessee heading into even 26, because Hurricane Ian took a while to kind of play out its aftershock effects, and it took time for some of that damaged property to start to make it onto the market as people started to realize, this roof's going to be too expensive to repair. My carrying cost have went up a lot. I've gone through this a couple different times. I'm not doing it again. Type of effect happened with Ian, and it took a while to play out. And I think you could see some of that with Hurricane Helene, and then even Milton into some pockets around Tampa. So if you look at this map, what you will notice is that it's pretty much green across the country. And yeah, there's some markets like Detroit where they're barely up for inventory, but almost everywhere is up for inventory. And so that's the trajectory we've seen actives move up over the past year. Now, this map is actives now versus pre pandemic. This one is really a great proxy for where the current supply demand equilibrium has landed in terms of the power dynamic between sellers and buyers. If you are dark green, buyers have gained a lot of power in your market. Places like Austin home prices are down 22%, or 16% if you use the Freddie Mac indice. But no matter what you look at, Austin prices, they've seen a material correction in prices. New Orleans, down for prices. Tampa, they're starting to fall again for prices. Had started to fall, then they started to move back up just a tiny bit, and now they're falling again. Punta Gorda, that's another market that's passed through a material correction. They're down 14, 15% for prices. So the green markets, where this actives have already moved above pre-pandemic levels and have moved even a clip above it, that's where buyers have the most power. And then the markets where sellers still have retained more power are the markets that are the dark brown. So these are markets that are still close to 40, 50% below pre-pandemic levels. But in these places, you are starting to see slowly inventory begin to build, like you've seen in Burlington, Vermont, with that 40% jump year over year. So let's keep an eye over the next year, and let's start to see if we start to see some more cooling in the Northeast, Midwest, and we start to see some of those markets that have been super tight. If we finally start to see that power dynamic move more to buyers. But in terms of the Gulf Mountain West region, that's really where buyers have gained more of the power and can find more of the deals. And a big part of that has been a slowdown in net domestic migration. Another big part of it has been that home prices went up even more than other places during the pandemic housing boom. And so now that net domestic migration is slowed into those markets, they have to rely more on local incomes to justify the prices. And that's just a problem, right? There's not enough buyers in some of these markets to meet where prices have gone to. So that's put downward pressure. And then the fact that insurance shock has been bigger in the Gulf. And then fourth, and this one is huge, is the fact that the Gulf and the Southeast and the Sun Belt, this is where the home building in the US has concentrated. And so builders, like you said earlier, when they have spec inventory, they make their money on volume. So they have to sell. And so if they have spec inventory that's not selling, they'll do affordability adjustments like bigger mortgage rate buydowns, maybe cut the outright price, increase the incentives to sell that product. And as they do that, and the buyers who are coming into the market they're stretched, right? They can't afford a lot, and given that one of the areas they're seeing discounting is new construction and affordability adjustments and, these buy downs, that's drawing their attention to the new construction market when they otherwise would have wanted and bought a resale or existing home. And so as that dynamic plays out, it means that existing and resale homes take longer to sell, and so they start to build for active inventory in those markets.
We're seeing that interest rates were unfazed, mortgage rates basically unfazed as a result of the small Fed cut that was made last year, late last year. We're now seeing that the Fed's holding steady, and not that the Fed rate affects mortgage rates, but it has historically mirrored one another. What are your expectations? I know you're not a man of predictions. You don't like to do that. You follow the data, but what are you thinking about with the mortgage rates? Are you expecting them to stay higher for longer? You're expecting to see this 6.5%, 7%. Do you think it's going to increase the actual mortgage rate, go higher?
Yeah. So a few thoughts here, which is the Fed sets the short term rate, but the long term rates, like the 10-year Treasury yield and mortgage rates, they're long term yields, right? They're long term rates. And so financial markets are really looking out, and they're basing those long term rates on their expectations for where future rates, short term rates go long term, where the economy goes long term, where the unemployment rate goes long term. And so they're trying to judge where things are headed. So mortgage rates have not been priced to where the financial markets would think that the Fed funds rate would have stayed at 5.5 long term, right? The financial markets have thought that that wouldn't last long term, right? And so we were never priced up to that level. And so the Fed coming off of the very peak of the federal funds rate hasn't had a material impact on mortgage rates yet because the market didn't even think we were really going to go to that level. Now, the reason that mortgage rates usually fall when the Fed is cutting the federal funds rate is because what's often driving the Fed to cut the rates is because the economy's weakening, right? The labor market's starting to weaken. And so they're trying to come out of restrictive and start to move somewhere to neutral or maybe to even easing. And so that's why we've seen this very close historical relationship there. But this time, when the Fed started to cut, the labor market had started to show a little bit of signs of weakening, right? If you go back to summer 2024, the unemployment rate between April 23 and July 2024 moved up from the cycle low of 3.4 to 4.2%. And the last couple of reports into summer 24, it started to move up fast, right? And so there was a little bit of an unease among central bankers and economists that maybe that move up was the start of the labor market moving into a period of greater weakness, right? And when it comes to rising unemployment, it can start really slow, right? And then very quickly shoot up. And so the Fed was a little uneasy there, and they didn't want to get caught too far behind the eight ball if they were wrong and the labor market was weakening faster than expected. So we started the rate cutting cycle, but not long after, I mean, pretty much once they had started, we had already started to see some of the data come in to support that, yeah, there is some softening occurring in the job market, but it's not weakening. It's not broad based weakening yet. And so the Fed kind of started to relax. Financial markets started to tighten back up because they looked out at the long term expectations for the economy, unemployment rate, federal funds rate, monetary policy, and the 10-year treasury yield moved back up, and the 30-year fixed mortgage rate, which had hit a 16-month low in September 2024, is now back up to 7%, right? So we've gone back up 80, 90 basis points, which has only put the pressure back on borrowing costs, pushed affordability back to where it was in terms of very pressurized levels. Now, what could move mortgage rates down would be if the unemployment rate were to spike up faster, right? If we were starting to see jobless claims move up quickly, if we started to see a real deterioration in the labor market. And now I understand that right now isn't a great time to switch jobs, right? And a lot of places aren't hiring, they're kind of just keeping on to who they have. I understand that there are real segments of the economy that are in real recession and have been there for 24, 36 months. Mortgage, right? Title. Some of these places that make their money on real estate transactions being an example. But in terms of broad based deterioration, we're more in a place of cooling and softening from the very overheated levels in 21 than we are at a clear deterioration for the labor market. And if we see that very clear deterioration for the labor market, that's when the long-term yields, long-term rates like mortgage rates will come down more than expected. But right now we haven't seen that yet. And if we do, that would be the when rates would come down more than expected. Otherwise, it's probably more of what we've seen, which is this higher for longer, right? And is an environment where you don't get many existing home sale transactions, right? Affordability is so strained because prices push so high so quickly. Now rates have went so high, and I kind of stayed there and haven't seen relief. And then now on the carrying cost, home insurance, property taxes, that's putting upward pressure on affordability. And so it's just a market where not a lot of people can afford to make the move, and so a lot of people are still clinging to, those lower monthly payments if they can keep it. Now, and I don't wanna get into this, I don't, because 'cause we've already went through so much in this one, but just because mortgage rates come down doesn't necessarily mean it's good for housing, because the thing that would drive it down is it could be a deterioration in the labor market, right? And, so I think that's one thing to keep in mind as well.
Yeah, I think, precisely, and that's what happened in '08. I mean, when we see unemployment rise, people can't pay their mortgages, they stop paying, and then you get a quicker, influx of distressed inventory on the market because people haven't been fixing up their homes, and yeah, that's kind of I think what I've always said, the labor market is the only thread that has really propped up this housing market and, given people the ability to afford their higher payments. The problem becomes if anything happens, right? I mean, we're seeing people with their debt to income ratios going so high that all of their money that they're working at their jobs basically going to housing and housing related costs right now, and that's really unsustainable. So I guess the magic in here, if there is any magic, is how do uh, keep the mortgage rates high to put pressure on pricing, downward pressure on the asset pricing without breaking the market, and at the same time lower the Fed rate so that businesses can borrow cheaper money so that they can keep their people employed and have some type of growth. And then at the same time, suppress inflation. And look, this is way above my pay grade, as far as trying to figure this out. But Lance, wow, I mean, so much to digest and think about. I have to say, out of everyone that I speak to, I agree with you. I mean, I think that you're so well founded in your information and your data that it really makes it easy to see where we are right now and where we're headed. And I just can't thank you enough for taking the time to come on our show, talk to our audience. I encourage everyone to, check out Lance. All of his links are in the show notes below. You just have to go to the description. And sometimes it's a little difficult. People have a hard time. You got to click more or whatever, expand the information. But as far as following him on X, certainly subscribe to Resi. If you're in the need to know basis in this industry and you're not following Resi Club, it's probably something that you want to consider doing. Lance, thank you so much.
Thank you for having me. Housing. Always so much going on.
Yes, sir. Well, we will look forward to bringing it back sometime real soon. Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.